Welcome to Sleepy Finance, your peaceful sanctuary for soothing financial stories designed to gently guide you into restful sleep. Before we begin tonight's journey, if you find calm and value here, please softly tap the like button, subscribe, and ring the bell. It supports our quiet mission and ensures you never miss a serene evening with us. Now, take a deep, relaxing breath, hold it for just a moment, and release slowly, letting your tensions drift away. Tonight, our tale unfolds in a quiet moment of global uncertainty, where trust was fractured, and from the digital shadows, an idea quietly stirred. The birth of something called Bitcoin. Act 1. The beginning. 2008 and the birth of Bitcoin. Let's go back to 2008. A global financial system had broken. Lehman Brothers collapsed. Bailouts were debated. Governments scrambled to contain damage. And the average person watched from the sidelines, confused, angry, uncertain. Trust had cracked. Banks failed. Pensions were wiped. Families lost homes. But more than that, the story people had believed in about money, stability, and institutions had faltered. And in the background of that crisis, something else appeared. On October 31st, 2008, a 9-page white paper was posted to a cryptography mailing list. The title, Bitcoin, a peer-to-peer electronic cash system. The author, Satoshi Nakamoto. There was no photo, no biography, no conference speech, just a name, maybe a person, maybe a group, and a paper. It didn't promise wealth. It didn't predict the future. It proposed an idea. What if money didn't need banks? What if trust could be replaced with verification? What if rules could be enforced by code, and no one could change them? The idea was simple but radical. A digital currency that couldn't be duplicated or forged. A network that didn't rely on any single authority. A system that anyone, anywhere could participate in, without asking permission. On January 3, 2009, the first block of Bitcoin was mined. It was called the Genesis block. Embedded inside that first block was a single line of text. The Times, March 1, 2009, Chancellor on brink of second bailout for banks. A timestamp, yes, but also a message. A quiet statement that this new thing, this software, this network, was created in direct response to failure. In the beginning, there was no price. There were no exchanges. Coins were mined on laptops, shared in emails, discussed on forums. There was no roadmap, no marketing, no institutional interest, just curiosity, skepticism, and a few minds wondering if it could work. Bitcoin was functional, but it was fragile. Blocks came slowly. The chain grew. A few transactions happened. Most of the world didn't see it. Or if they did, they dismissed it. Digital tokens with no backing, no government, no real-world application. But that's what made 2008 to 2009 significant. To buy Bitcoin then, or to even pay attention to it, required vision. You had to read the white paper. You had to download the software. You had to mine or receive coins that weren't worth anything. And you had to do all of it in a world that wasn't listening. There was no market. There was only an idea. And that's where every movement begins. The Genesis block wasn't just a piece of code. It was a fork in the road. One direction pointed back to central banks, bailouts, and dependency. The other pointed toward something different. Bitcoin didn't solve the system in 2009. It didn't change the world overnight. but it showed what was possible. And more importantly, it started running. Without a pause, without a reset, without asking anyone's permission. It's still running now. And it all started when no one was looking. Even in those early days, building wasn't easy. The code was raw. The software lacked polish. Running a node required effort and patience. There were no tutorials, no support teams, just forums filled with quiet experimentation. Developers pushed updates. Users tested features. Everything was trial and error. Yet block by block, the system held. Bitcoin wasn't flawless, but it was alive. And there were signs, small ones, that people were beginning to see it. A post here, a transaction there, an academic paper citing the protocol. Tiny sparks scattered across the internet. Most still ignored it. But for the few paying attention, the direction was becoming clear. This wasn't just about a new form of money. It was about redefining the relationship between individuals and systems. About proving that value could exist outside permission. By the end of 2009, Bitcoin had processed its first transactions. Hal Finney, one of the early cryptographers, received coins directly from Satoshi. Not as an investment, not as a trade, just as a test. A handshake across a network no one controlled. That moment didn't make the news, but it made history. What began as text on a mailing list had turned into a working system. No ads, no funding, just code, commitment, and time. It was real. It was live. And whether anyone believed or not, it was still moving. End of Act 1. Act 2, The Quiet Years, 2009 to 2010. By early 2009, Bitcoin was live, but barely noticed. Most people had never heard the word. It lingered on obscure mailing lists and flickered across niche forums. There was no market, no exchange rate, no headlines. It simply existed. Those who saw it early weren't investors. They were cryptographers, tinkerers, and idealists, curious about a system that claimed to work without trust. On January 3, 2009, the Genesis block was mined. Embedded inside was a message. The Times, March 1, 2009, Chancellor on brink of second bailout for banks. It wasn't an accident. It was a marker. A clear reference to the world Bitcoin was built in response to. But for months, the code ran in the background of the internet, mostly unacknowledged. Early Bitcoins were mined using laptops. There was no competition. Mining was more of a technical experiment than a financial activity. Blocks were solved every 10 minutes, not by corporations, but by individuals, alone in bedrooms, garages, basements. CPUs hummed, fans spun, and quietly, Bitcoin's ledger began to grow. The first known transaction happened on January 12, 2009. 10 coins were sent from Satoshi Nakamoto to Hal Finney. Not as a trade, but as a test. There was no price, no value, just proof that the system worked. Through 2009, Bitcoin remained underground. Developers submitted patches. Users tested features. There was no marketing, no product team, and no customer support. Just a small community, slowly shaping a protocol they barely understood the future of. To the outside world, Bitcoin didn't exist. The news was focused on recovery. Bailouts, stimulus, and central bank policy dominated the headlines. Few knew a parallel system had quietly come online, one that wouldn't need bailouts, one that couldn't be inflated, one that didn't ask for permission. By 2010, the network had grown, but just slightly. More people found the white paper. Some downloaded the software. A few started mining. A handful traded coins directly, often as experiments, gifts, tips, or gestures. Sometimes coins were lost, forgotten, left behind on drives that would later be thrown away. Forums became slightly more active. Ideas started to form. IRC chats hosted long technical conversations, many of which are still archived today. The word Bitcoin appeared a little more often, still misunderstood, still mostly ignored. There were no apps, no wallets with slick interfaces, no QR codes, just raw code, command lines, and those patient enough to learn how it worked. And despite the friction, the system kept running. 10 minutes at a time, the blockchain expanded. Some users started to grasp what they were part of: a financial network with no center, a currency with no issuer, a monetary system that enforced its rules by software, not decree. Bitcoin was slow, but it was consistent. And while most of the world paid no attention, the protocol gained strength. Not through hype, but through survival. Bitcoin had not yet proven itself. It hadn't crashed, but it also hadn't succeeded. It was simply there, building quietly, invisible to most, but alive. Some developers focused on improving the codebase, patching bugs, and stabilizing the network. Others began experimenting with new use cases: escrow functions, marketplaces, timestamping. Each update wasn't just about making Bitcoin easier to use, but proving it could handle real-world friction. Even though there were no businesses accepting it, no apps for phones, and no guides for beginners, a few began to treat Bitcoin like a serious project. Outside the small group of early users, Bitcoin remained invisible. No mainstream publication covered it. No economist studied it. If someone mentioned it, they were likely met with confusion or a shrug. That silence, however, gave it space. Space to evolve, to be tested without pressure, to survive without promotion. In mid-2010, something changed. A developer named Laszlo Hanyecz posted an offer online: 10,000 bitcoins in exchange for 2 pizzas. A few days later, someone accepted. Laszlo placed the order. 2 pizzas arrived. The transaction was simple, but symbolically, it was huge. It proved Bitcoin could be used to buy something tangible: real food in the real world for digital currency. 10,000 bitcoins for pizza wouldn't mean much until years later. But at the time, it showed that Bitcoin had value, not assigned by a central authority, but agreed upon between 2 people. It wasn't just theory anymore, it had utility. That same year, the first exchange appeared, Mt. Gox. It allowed people to buy and sell bitcoins using fiat currency. Suddenly, Bitcoin had a price. People could track it, argue about it, react to it. The appearance of a market changed the conversation, but it didn't make Bitcoin mainstream, not yet. The number of users was still tiny, the liquidity was low. But something fundamental had shifted. Bitcoin could now be traded, spent, and stored. By the end of 2010, the Bitcoin network had gone from an obscure code experiment to a functioning, albeit fragile, financial protocol. Still tiny, still unknown, but alive and evolving. End of Act 2. Act 3, A Dollar and a Dream, 2011. In February 2011, Bitcoin reached parity with the US dollar. 1 Bitcoin equaled $1. It wasn't a headline event. There was no media coverage, no breaking news alert. But to the few watching, it meant everything. For the first time, Bitcoin had a measurable value against a global standard. What was once an experiment in open source money now had a price. Before that moment, Bitcoin had existed for over 2 years with no formal exchange rate. Coins were traded informally on forums or given away. The launch of Mt. Gox, the first major Bitcoin exchange, changed that. Built on a repurposed trading site, Mt. Gox allowed users to buy and sell Bitcoin with fiat currency. It wasn't polished, it wasn't fast, but it worked. Buyers met sellers, orders were matched, and a market was born. That price, $1, was more than a milestone. It was validation. It proved that Bitcoin could be exchanged, not just mined or tested. It meant that people on opposite sides of the world could agree on the value of something that no one controlled. Not a government, not a company, just code. Other signs of progress followed. In May 2010, developer Laszlo Hanyecz had already demonstrated that Bitcoin could be used in the real world. He offered 10,000 Bitcoins in exchange for 2 pizzas. Someone accepted. The food arrived. It wasn't a joke. It was the first real-world purchase with Bitcoin. At the time, the coins had no widely accepted value, but the trade proved that Bitcoin could be used as money, a simple transaction, but symbolically one of the most important in its history. By mid-2011, interest was building. More users downloaded the client. More developers contributed to the code. Mining was no longer something done on a spare laptop. Difficulty had increased. GPUs were starting to replace CPUs. Bitcoin was still niche, but it was growing. Forums that had once been quiet were now active. IRC channels ran day and night. People shared ideas, debated technical changes, and reported bugs. Others helped newcomers understand how to run a node, store their keys, or avoid scams. Most of these early users weren't trying to get rich. They were here to see what it could become. Skepticism remained strong. Most economists dismissed Bitcoin as unserious. The mainstream media rarely covered it, and when they did, it was often with condescension. Digital tokens? Internet points? It didn't sound like a threat to anything. But that's why 2011 mattered. Bitcoin had reached a price but not acceptance. It had proven utility but not scale. It had gained users but not mainstream support. And that gap between working and being understood is where conviction lives. Those who paid attention in 2011 weren't guessing. They were observing. Watching the network run even when no one cared, tracking block times, following the hash rate, reading the white paper again. Bitcoin was no longer just an idea. It was functioning software, a growing network, and a live financial system, all operating in the open. By the end of 2011, thousands had heard of Bitcoin. A few hundred had used it. But the number who truly understood what it represented was still very small. And that's why buying then mattered. Not because it was obvious, but because it wasn't. To engage with Bitcoin in 2011 was to take it seriously before most people knew it existed, to study it before headlines, to use it before marketing, to believe in it while it was still vulnerable. Bitcoin was alive. It had a price, it had a user base, and it had critics. But it was still early. Most of the world didn't see it. But those who did, and who stayed, weren't just holding coins. They were holding understanding. There were other growing pains too. Wallet software was clunky and risky. Backups failed. Lost keys meant lost funds, permanently. There was no customer support, no reset button. Users had to learn not only how to manage their coins, but how to protect them. For some, this friction was frustrating. For others, it was part of the appeal. It forced responsibility. It made ownership real. Meanwhile, exchanges like Mt. Gox introduced both possibility and risk. Liquidity was shallow, prices were volatile, and behind the scenes, the systems were fragile. The infrastructure was years away from being ready for mainstream use. But for now, it was enough. It gave Bitcoin a reference point, a place to be seen. There were small meetups in cities like San Francisco, Berlin, and Tokyo. People brought laptops, they traded coins, they debated forks and protocol changes. Some were driven by ideology, others by curiosity. But no one was here for hype. There was none. The software continued to evolve. Developers like Gavin Andresen took over from Satoshi, who had begun stepping away from the project. Code commits were made. The client improved. Bug fixes were rolled out. Progress was slow but constant. No leadership team, no budget, just volunteers and belief. Even with progress, Bitcoin remained fragile. A bug in August 2010 created billions of coins in a single block. The issue was caught quickly, the chain was rolled back, and the bug was patched. It was a crisis and a test. The community passed it. But the episode was a reminder Bitcoin was still experimental. Mining was changing fast. GPUs made CPUs obsolete. Hash power increased. Mining pools emerged. Competition grew. With it came questions about centralization, fairness, and future sustainability. These discussions didn't have clear answers, but they were already being asked. And slowly, a pattern began to emerge. Bitcoin would gain attention, spark curiosity, and then be forgotten. The cycle repeated. Each time a few more people stayed, a few more understood. The users who stayed through 2011 didn't always buy large amounts. Many simply mined, tested, or held a few coins to see where it would go. But even that required conviction. There were no price predictions, no YouTube explainers, just a white paper, a wallet, and a choice. Bitcoin had started as an idea. By 2011, it had become a system, still fragile, still evolving, but real. Not because people believed in it, but because it kept working. End of Act 3. Act 4. In the Silence, 2012. In 2012, Bitcoin still wasn't mainstream. Most people had no idea what it was. There were no commercials, no mobile apps, no institutional interest. It had a price, but no place in the financial system. It was growing, but growing in obscurity. The mainstream media rarely mentioned it, and when they did, it was with skepticism. News anchors joked about imaginary coins mined on imaginary computers. Economists dismissed it as a speculative fantasy. To the average person, Bitcoin was either unheard of or misunderstood, not something to be taken seriously. But while public attention drifted elsewhere, the protocol kept moving. Blocks were mined every 10 minutes, transactions confirmed. Developers kept contributing to the codebase. Wallets improved. Forum posts increased. More people quietly discovered it and started asking questions. There were no major headlines, but there were quiet breakthroughs. More nodes came online. More miners joined. Cold storage became a topic. Security practices evolved. Terms like hash rate, fork, and confirmation time became part of the early vocabulary. The learning curve was steep, but those who stayed took the time to understand it. 2012 also brought the first real discussions of scaling. People began thinking about what Bitcoin might look like with 100,000 or 1 million users. These weren't business plans. They were technical debates. Could the protocol handle it? What would break first? And while those debates happened online, in living rooms and basements, the world outside didn't notice. There were no policy statements, no government white papers. Most financial institutions had never even heard of it. But the silence gave Bitcoin space. It allowed the system to mature without pressure. Mistakes were made, wallets were lost, bugs were discovered. The client still crashed from time to time, but the network didn't stop. And each issue was a chance to make the protocol stronger. The people building in 2012 weren't looking for headlines. They weren't chasing price. They were focused on the code, the network, and the principles behind it. They believed in what Bitcoin could be, not just what it was. There were early developers, miners, writers, and educators. Some were anonymous. Others would become known later. Many were ignored at the time. But they laid the groundwork for everything that came next. They kept going without support, without guarantees, without recognition. They did it because they believed a decentralized system should exist, because they'd seen what happened when systems were based on trust instead of transparency. And Bitcoin quietly offered something else. It didn't require belief in a person or an institution, just belief in rules, fixed supply, transparent ledger, predictable issuance. It didn't solve every problem, but it didn't break either. By the end of 2012, Bitcoin had not gone viral. It had not crashed. It had not succeeded. It had simply survived. That was enough. Bitcoin didn't need attention, it needed time. And it got it. Block by block. It continued. Developers refined the client. The Bitcoin Core software improved. Bugs were patched. Documentation slowly got better. GitHub commits told the story, not of a company shipping a product, but of an open protocol being shaped by its users. This wasn't a race to go public or launch a token. It was infrastructure work, line by line, version by version. Some contributors dropped off, others joined. Pseudonyms came and went. There were no press releases, no roadmaps, just changelogs and forum threads. But under the surface, the protocol became more stable. Syncing nodes got easier. Transaction propagation improved. Wallet backups became safer. Progress was slow, but real. There were small meetups, 5 or 10 people in a room, laptops out, charts on whiteboards, conversations about hash rate and block size, no branding, no sponsors, just people who thought they were onto something important. 2012 also marked the start of Bitcoin's first real legal discussions. Governments weren't writing regulations, but regulators began to notice. FinCEN, the U.S. Financial Crimes Enforcement Agency, started asking questions. What is this thing? Is it money? Who controls it? The answers weren't clear, but the attention was new. This uncertainty brought debate within the community. Should Bitcoin remain a currency, a payment network, a digital gold? These questions weren't settled, but the fact they were being asked meant one thing. Bitcoin was starting to matter, even if only to a small, persistent group. Open source contributors worked on wallet compatibility, cross-platform functionality, security audits. The work was unglamorous, but it made Bitcoin easier to use. For the first time, someone with no coding background could send and receive coins with a graphical interface. BitcoinTalk.org became the central hub. Threads covered everything from mining hardware to philosophical debates about inflation. Many early figures who would later be well known were active in 2012, answering questions, debating ideas, and sharing new tools. The economic backdrop hadn't changed much since 2008. Interest rates remained low. QE was still underway. Trust in traditional finance hadn't recovered. But most people still hadn't looked for an alternative. Bitcoin wasn't filling a mainstream demand. It was being built before the demand arrived. By late 2012, the hash rate had increased significantly. Mining was no longer feasible on standard laptops. ASICs were coming. A new era of industrial mining was on the horizon. But for now, it was still a DIY network, small enough that individuals could shape it. Bitcoin had not yet become a movement, but it had momentum. It had survived another year. The network was still online. Blocks were still arriving. The software had matured, and the conversation, though quiet, had deepened. Bitcoin's value wasn't in its visibility, it was in its resilience. And by the close of 2012, that resilience was becoming harder to ignore. End of Act 4, In the Silence, 2012. Act 5, Emergence and Misunderstanding, 2013. In 2013, Bitcoin became visible. For the first time, it was being mentioned outside of niche forums and developer chats. It showed up in headlines, blog posts, and financial conversations. The price had reached new highs, first $100, then $1,000. It was no longer just a code experiment. It was a market. But visibility didn't mean understanding. Bitcoin was gaining attention, but not for the right reasons. It was associated with the Silk Road, an online marketplace operating on the dark web. Bitcoin was used as a payment method there because it allowed peer-to-peer transactions without a bank or identity verification. That wasn't Bitcoin's purpose, but it made it an easy target for media narratives. Articles focused on crime and anonymity, not technology or monetary policy. At the same time, Mt. Gox was becoming the dominant exchange. It handled most of the world's Bitcoin trading volume. For many, it was their first on-ramp into crypto. But beneath the surface, Mt. Gox was unstable, poorly managed, vulnerable to hacks and misreporting balances. In late 2013 and early 2014, the cracks became clear. Withdrawals were delayed. Users complained. Then it collapsed. Over 800,000 bitcoins were lost or stolen. The fallout was massive. Prices crashed. Trust evaporated. Critics pointed to Mt. Gox as proof that Bitcoin had failed. But those who understood knew that Mt. Gox wasn't the protocol. It was just a faulty service built on top of it. Bitcoin itself never stopped running. The blockchain kept producing blocks. Transactions kept confirming. The rules of the protocol remained intact. It was a painful reminder of the difference between Bitcoin the system and Bitcoin the companies built around it. 2013 was also the year of Bitcoin's first major speculative cycle. New investors bought in. Forums filled with price speculation. Media outlets began asking whether Bitcoin was the future or just another bubble. Comparisons to tulips, beanie babies, and the dot-com era were everywhere. For early users, the attention was strange. Some welcomed it, others worried. The ethos of Bitcoin had never been about fast profit. It was about long-term independence, verifiable supply, and resistance to control. Still, more infrastructure began to emerge. Wallet providers improved, mining pools consolidated, startups formed, meetups expanded into conferences. For the first time, people were trying to turn Bitcoin into a business. But the technology wasn't ready for the scale. Wallets were still difficult to use. Security was fragile. Onboarding new users required education. The user experience was years behind traditional finance. Yet the interest kept growing. The divide between hype and substance widened. Some came for the promise of fast money. Others came to build. And in that mix, the core principles were often lost. There were those who held on to their coins, not because they expected a quick return, but because they understood what it represented. These were the early hodlers, the ones who didn't panic during price swings, the ones who remembered when Bitcoin had no price at all. The term hodl itself was born in 2013 from a typo on a message board. It became more than a joke. It became a signal of patience, of conviction, of time preference. Bitcoin was no longer a secret, but it wasn't yet accepted. It was known, but not believed in. To many, it was a bubble. To some, it was a tool. To a few, it was a movement. The year ended in confusion. Bitcoin had reached unprecedented heights and suffered devastating losses, all in a matter of months. It had entered the public conversation, but mostly through controversy and speculation. And yet, beneath all of it, the network kept running. The nodes didn't stop. The blocks didn't pause. The system didn't bend. Bitcoin had not succeeded, but it had survived another test. It had crashed, it had climbed, and it had not gone away. More changes were happening behind the scenes. Bitcoin Core developers continued improving the client. Code was reviewed, tested, and pushed to GitHub. Discussions about scalability and block size began to take shape. There were still few users, but the technical foundation was being quietly strengthened. Some developers proposed ideas for privacy enhancements. Others focused on making wallets more secure and user-friendly. Bitcoin Talk remained the central hub for everything: project announcements, exchange updates, bug reports, and speculation. Altcoins were starting to appear, many as forks of Bitcoin, most without lasting traction. Some users experimented with these alternatives, but Bitcoin remained the primary reference point. At the same time, mining was changing rapidly. ASICs, application-specific integrated circuits, began to dominate the hash rate. Individual mining on laptops or GPUs was no longer viable. Mining became professionalized. Warehouses filled with machines came online. The hash rate soared, and concerns about mining centralization began to emerge. For many early participants, this was the end of the DIY era. Despite the challenges, a few developers, miners, and users stayed focused on Bitcoin's core use case: censorship-resistant, peer-to-peer value transfer. They saw through the noise and maintained perspective. The core arguments, fixed supply, decentralization, transparency, still held. But it was getting harder to keep that message clear amid the growing noise of price speculation. Still, Bitcoin survived 2013 with greater global awareness, a growing ecosystem, and a tested working network. It had withstood technical bugs, criminal headlines, exchange failures, and price volatility. And it was still here. Bitcoin didn't need to be understood by everyone yet. It only needed to keep functioning and to keep attracting those willing to learn. End of Act 5. Act 6, Quiet Resilience, 2017 to 2020. In late 2017, Bitcoin re-entered the public eye, not as a fringe experiment, but as a headline. Its price had climbed rapidly, breaking past $10,000, then $15,000, eventually nearing $20,000. For the first time, people who had never heard of Bitcoin just months earlier were suddenly asking about it. Television anchors debated it. Family members brought it up at dinner. Celebrities tweeted about it. The rise felt sudden to the world, but to those who had been watching for years, it was a long time coming. The network had matured. The infrastructure had improved. Exchanges were easier to use. Wallets were more secure. The ecosystem had grown, but few outside it had noticed until the price surged. Old users reopened wallets they had long forgotten. People who mined in 2011 out of curiosity now saw balances worth life-changing sums. Some celebrated, others panicked. Passwords were lost. Private keys were unrecoverable. But beyond the individual wins or losses, one thing was clear. Bitcoin had become visible again. And then just as quickly, the price fell. The crash of early 2018 shook out many new arrivals. Media coverage turned skeptical. Articles warned of bubbles and fraud. Critics resurfaced. Bitcoin, they said, had once again failed to live up to the hype. But the protocol didn't flinch. Blocks kept coming every 10 minutes. Transactions continued. The software kept running. Developers kept building. The people who remained weren't here for short-term gains. They were here because they understood the foundation. These were the same people who remembered when Bitcoin was worth a few cents. They had weathered crashes before. This one wasn't new, it was familiar. Through 2018 and 2019, the noise faded. Prices stayed low. Public interest cooled. But in the background, real progress continued. Wallets became more user-friendly. The Lightning Network gained traction. Cold storage security advanced. Infrastructure scaled quietly. Meetups became more serious. Conferences more technical. Less hype, more protocol design. Builders focused on stability, scalability, and education. Open source contributors didn't stop when the prices did. They rarely had. Institutions began to observe. Banks issued internal memos. Family offices started doing research. University courses referenced the Bitcoin whitepaper. Regulators explored frameworks. Quietly, methodically, the system's credibility was being reassessed. Meanwhile, the mining industry became more industrialized. ASICs dominated. Mining moved to regions with cheap energy. Concerns about centralization and sustainability grew. These challenges weren't ignored. They sparked conversations about incentives, decentralization, and governance. Bitcoin, which had once been dismissed as a toy, now posed a real question. Could a decentralized protocol operate at a global scale? The fact that it hadn't disappeared was its own answer. In 2020, amid global uncertainty and historic economic interventions, attention returned. Central banks were printing at unprecedented levels. People began looking again at fixed supply alternatives. Bitcoin wasn't a theory anymore. It had a history, a track record. Large companies made their first moves. Square and MicroStrategy added Bitcoin to their treasuries. PayPal enabled Bitcoin purchases. For the first time, institutions didn't just talk, they acted. Bitcoin was still volatile, still debated, but no longer irrelevant. The conversation had shifted from whether it would survive to what it might become. And through it all, Bitcoin remained unchanged. No CEO, no marketing team, no bailout, just code, consensus, and time. By the end of 2020, something was clear. Bitcoin had entered a new phase. Not mainstream adoption, but mainstream awareness. The skepticism hadn't vanished, but it had been joined by something new: respect. The early believers didn't need to say anything. They had already said it. In 2011, in 2013, in 2017. They had held not just coins, but conviction. And now, as the world slowly reconsidered what money could be, Bitcoin was part of that conversation. It had risen, it had fallen, and it had never gone away. Governments also began paying closer attention. Some explored ways to regulate or monitor crypto exchanges. Others discussed central bank digital currencies as a response to decentralized assets. Bitcoin, once beneath their radar, was now being discussed in policy rooms and financial oversight committees. In the European Union, in Asia, in the US, digital asset regulation became a talking point. It wasn't clear whether governments saw Bitcoin as a threat or an opportunity, but they no longer ignored it. Technological innovation accelerated. The Lightning Network, once experimental, matured into a usable solution for faster and cheaper transactions. Wallets became more mobile-friendly. Custody solutions, once a serious barrier for institutional interest, improved with the introduction of hardware wallets and qualified custodians. Multi-signature setups became standard practice for those managing larger sums. Bitcoin was becoming more usable, more secure, and more accessible, not just for developers, but for everyday users and institutions alike. The narrative surrounding Bitcoin also began to shift. No longer just a currency or a payment system, it was increasingly described as digital gold. Investors began to frame it not as a competitor to Visa, but as a hedge against inflation and monetary instability. This reframing opened new doors. Legacy institutions that had previously dismissed Bitcoin as a failed payment tool now reevaluated it as a long-term store of value. Hedge funds and macro investors quietly began to allocate. Behind the scenes, education was improving. More podcasts, documentaries, and long-form research reports were published in these years than ever before. Bitcoin was no longer a niche curiosity for technologists. Financial professionals, students, and entrepreneurs were learning about it in a structured way. Public universities offered courses, think tanks wrote reports. The community's efforts to explain Bitcoin, not just hype it, were beginning to pay off. More importantly, the network itself didn't change. Through all the excitement, the crashes, the speculation, and the investment rounds, Bitcoin's protocol remained the same. It didn't bend to political pressure. It didn't pivot. There was no rebrand, no soft fork for mass appeal. It simply kept doing what it was designed to do: settle transactions, enforce monetary policy and code, and remain neutral to the chaos around it. As 2020 ended, global markets remained fragile. Trust in institutions was low. And quietly, Bitcoin stood as an alternative, still young, still debated, but stronger than ever. It had become more than a novelty. It had become infrastructure. End of Act 6. Act 7, the global stage, 2020 to present. Bitcoin was no longer a rumor. It was no longer a niche topic buried on forums. No longer something only the strange, the stubborn, or the visionary had spoken of. By the early 2020s, it had become something else entirely. Visible, recognized, and debated. Screens across the world now displayed the name, in airport terminals, on trading dashboards, during earnings calls and investment pitch decks. Quietly, consistently, Bitcoin appeared. In 2021, something shifted. The number, one so many thought unreachable, arrived, and then passed. Bitcoin broke $20,000, then $30,000, then $60,000. But this was not triumph. It was a threshold, a point of no return. For many, it was their first encounter with the asset. Portfolios updated, screens flashed green, apps trended, and still, the questions remained. What was it? What made it rise? Was it too late? Companies began adding Bitcoin to their balance sheets. Tesla made headlines. MicroStrategy bought aggressively. Other corporations followed more quietly. For some, it was a bold move. For others, a hedge. Very few truly understood why. It appeared in quarterly reports, but not always in conviction. Governments noticed, some with suspicion, some with curiosity, a few with ambition. In 2021, El Salvador declared Bitcoin legal tender, becoming the first country to embed it in law. There were speeches, protests, Chivo wallets, technical glitches, and headlines. But beneath it all was a test. Could a stateless digital currency coexist with political systems built on control? Other governments began writing regulatory frameworks. Some aimed to integrate, others to suppress. Central banks rushed to develop digital currencies of their own. Bitcoin had gone from being ignored to being studied. The protocol hadn't changed, but the world around it had. Meanwhile, institutions entered cautiously. Legacy banks launched crypto desks. Investment firms offered exposure through trusts and ETFs. Bitcoin moved from the fringe to financial products, retirement portfolios, and brokerage platforms. Yet adoption didn't always mean understanding. Bitcoin was being bought, but not always studied. It was on charts, not in conversations. It was a line item, not a worldview. The people who had been there from the beginning didn't celebrate loudly. They had seen this cycle before: euphoria, backlash, misunderstanding. Their conviction wasn't shaken by price. They had held through silence, through ridicule, through crashes that wiped out 80% of value. They didn't need to defend it anymore. In the background, development continued. Taproot activated in 2021, improving privacy and smart contract flexibility. The Lightning Network matured. UX improved. Global node counts remained high. Bitcoin was becoming more usable and more decentralized, even as most attention focused on its market cap. Media narratives evolved. Bitcoin was no longer just magic internet money. It was digital gold, a hedge, a curiosity, a threat, an opportunity. Its meaning shifted based on who was talking, but the code remained indifferent. Bitcoin did what it always did: one block every 10 minutes, rules enforced by consensus, no leader, no central authority, no bailout, no shutdown switch. And that was the point. In classrooms, the white paper became assigned reading. In boardrooms, executives asked for explanations. In politics, it became a wedge issue. In social media, it was praised and mocked, often in the same feed. Everyone had an opinion. Few had understanding. And through it all, Bitcoin kept proving its core idea that rules, not rulers, could anchor a monetary system. That a fixed supply, transparent ledger, and permissionless access model could survive in a chaotic world. Bitcoin had become real, but it hadn't become understood. It had taken over headlines. It had entered policy conversations. It had broken into institutional portfolios. But maybe, just maybe, it still wasn't too late. By 2023 and into 2024, the conversation shifted again. The United States, once hesitant, began adopting a more crypto-friendly tone. New legislation focused on regulatory clarity. ETFs were approved, custodians were licensed. Bitcoin was no longer just tolerated, it was being integrated. As the political climate evolved, so did the rhetoric. With Donald Trump campaigning again and voicing support for American innovation in blockchain and digital assets, Bitcoin became a topic not just of financial strategy, but of national identity. Political candidates spoke about Bitcoin as a tool for financial independence, and some began proposing pro-crypto legislation to attract younger voters and tech-focused entrepreneurs. The tone from Washington was changing, from cautious resistance to strategic interest. Even more remarkably, discussions began surfacing about including Bitcoin in sovereign reserves, not just at the fringes, but from credible voices. Central banks and treasury departments debated the long-term viability of holding a small percentage of reserves in Bitcoin, particularly as a hedge against fiat instability or geopolitical fragmentation. It was no longer unthinkable. It was becoming a real consideration. While still debated, these conversations were more grounded than ever before. Bitcoin was no longer being dismissed. It had a seat at the table. Quietly, in government buildings and global institutions, people were asking what a world might look like where Bitcoin plays a small but critical role in the global financial system. Bitcoin had been called many things, a joke, a scam, a bubble, but through every cycle it kept moving. Through every critique it kept functioning. No lobby, no board, no marketing department, just rules, just uptime, just time. By 2024, Bitcoin was no longer just an asset class. It was infrastructure, and the world was beginning to treat it that way. By 2025, the conversation was no longer speculative. The United States government formally confirmed that Bitcoin had been added to its strategic reserves, a decision that was once considered unthinkable. In official statements, it was described not as a gamble, but as a diversification strategy, a hedge against future economic instability, a recognition of a new global financial architecture already forming in real time. With Bitcoin now priced at $111,000, the implications were clear. The asset that once traded for less than $1 now had a role in the balance sheets of superpowers. Analysts compared it to gold. Central banks debated allocation models. Quiet meetings turned into policy discussions. Even the IMF and World Bank issued new digital asset reports referencing Bitcoin as a systemic factor, not a fringe asset. This development didn't mean everyone suddenly understood Bitcoin. There was still disagreement, still resistance. But it could no longer be dismissed as a passing phase. It was official, it was sovereign, and it was permanent. Bitcoin had moved from software to speech, from networks to nations. It had passed the tests of time, volatility, misinformation, and coordinated resistance. Now, the questions were bigger. What does a world look like when the reserve currency coexists with an incorruptible one? How do financial systems adapt when scarcity is enforced by code? What happens when governments store what used to be mined in basements? No one had all the answers, but one thing was clear. Bitcoin's place in the global financial system was no longer a debate. It was a reality. End of Act 7. Act 8. Why it's not too late. So, why should you have bought Bitcoin in 2011? Because it was early. Because it was misunderstood. Because few believed. Back then, Bitcoin was a strange idea on obscure forums. It had no institutional support, no real-world adoption, no headlines worth noticing. It was run by hobbyists, miners with laptops, developers with principles. There were no price targets, no roadmaps, just code, open, neutral, and persistent. Buying Bitcoin in 2011 wasn't about profit. It was about conviction, seeing potential in something unproven, uncertain, and unfinished. It meant stepping into a space that most people either mocked or ignored. It meant choosing to believe in the rules of math over the rules of men. And now? Now the landscape has changed. Bitcoin is no longer hidden. It's no longer only for the tech-savvy or the libertarian idealist. It's not obscure, but it's still early. Because Bitcoin has not yet reached its full story. So why might you still have a chance? Because Bitcoin is still scarce. The supply is fixed. 21 million coins, and most have already been mined. No one can print more. No central bank can expand the supply. No politician can dilute it. That kind of predictability is almost extinct in modern finance. Because adoption is just beginning to scale. Tesla bought it. MicroStrategy turned it into corporate treasury strategy. Governments like El Salvador made it legal tender. Institutional investors now hold it. Bitcoin ETFs have entered traditional markets. For the first time, legacy finance is beginning to wrap its systems around an asset it cannot control. But adoption doesn't mean saturation. The world's central banks still hold none. Most people still don't own any. Many still don't understand what it is or why it matters. Because the infrastructure is still growing. In 2011, Bitcoin was barely usable. In 2015, it was clunky. Today, we have mobile wallets, hardware wallets, Lightning Network payments, Layer 2 innovation, on-chain analytics, multi-sig, privacy enhancements, institutional-grade custody. The ecosystem is becoming more usable, more scalable, and more accessible. And yet, Bitcoin is still misunderstood. Many treat it like a stock. They think of it in quarters, in charts, in memes. But Bitcoin doesn't pay dividends. It doesn't issue shares. It doesn't make promises. What it offers is something else. A monetary system with no central authority. A protocol that doesn't care who you are. A network that cannot be turned off. And that's where your opportunity lives. Not in being the first, but in being early enough to recognize that trust is shifting, that systems built on permission are showing their cracks, that in an era where value is manipulated, something outside the system still quietly works. Bitcoin is borderless. It doesn't stop at customs. It doesn't require ID. It doesn't shut down on weekends. It moves, block by block, through conflict, through regulation, through every attempt to fit it into boxes it was never designed to occupy. It has survived China's mining ban. It has survived exchange collapses. It has survived forks, fears, crashes, misinformation, and manipulation. It has survived being ignored. And it has survived being attacked. Why is it not too late? Because Bitcoin is still running. Because the system still works. Because the narrative has changed. But the fundamentals have not. And because understanding Bitcoin today is like understanding the internet in 1998. It's real, it's global, it's growing. But it's still early enough that most people don't really get it. Not getting rich overnight doesn't mean you missed it. Buying a decade after launch doesn't mean you're late. Bitcoin is measured in decades, not days. And when something is designed to last 100 years, entering in year 12 is still early. The question isn't, what's the price today? The question is, what will this technology mean in 20 years? Because Bitcoin today is no longer a concept. It is infrastructure, it is settlement, it is monetary policy and code. And it's just beginning to be tested at scale. The chance you have now is not to catch a wave. It's to understand a foundation. You don't have to guess a price. You don't have to rush. You just have to see what's already here and imagine where it might go next. To notice that in a world of noise, Bitcoin remains signal. To realize that in a world of inflation, Bitcoin remains fixed. Bitcoin wasn't just about being early, it was about being aware. It was about seeing clearly. It was about choosing certainty in a world of change. And maybe, even now, you still can. End of Act 8.